I got to do a few things here manually. One, which is run bada bing, the Cboe Exchange-Traded-Profile. We're going to be talking some of the really good ETFs that are listed here. Today, that's going to be with a little bit of a crypto tilt to it. Mr. Kevin Kelly from Kelly Intelligence is on the Zoom. Oh, we got Pete still. Hold on, I got it. Watch me work, baby. Watch me work. Okay. There he is, Mr. Kevin Kelly. What's up, my dude?
Hey, you know what? I think everyone was excited on the floor about, these ETFs we're going to talk about.
Yeah, exactly. They heard, that's exactly what they heard. These are the guys that are, trading to make sure that your ETFs are running smooth. You guys launched BITY and BAGY, which were really kind of the stalwarts of the income-driven crypto funds. As crypto's getting hit right now, tell me what the holders of those funds are experiencing.
Well, yeah, I mean, there's definitely been a downdraft, and we've actually seen the net asset values come down, and that's just because we have exposure to Bitcoin. But what's happened is we've actually seen increased volatility, so that's good for strategies like ours, where we write against the volatility. Right, the whole premise of what we're trying to do with our suite is to monetize volatility while having long-term exposure to the asset class. Like, our strategies aren't meant to be traded, because what we do is we actually own exposure to the asset class, and then we sell volatility against it every single week. And so what we want to do is we want to serve a portion in the portfolio to generate high amounts of income. So BITY, for example, pays out 2% a month. We've got ETY, which is ETTY, which pays 3% for 3% for Ethereum. And then we just launched on Tuesday our Solana one, which pays 3% monthly as well. And so, these are meant to be long-term holds. You want exposure to the asset class. People should have exposure within, their portfolios to digital assets because they're technology networks. And so we've seen technology networks, from their infancy in the 80s to now perform well over the long run. So that's the purpose.
Who are you finding most right now likes the idea of the income version of crypto? Is it folks who are trying to use equities to do the same thing, to fill the bond side of the 60-40 that they think needs something different? Because if you really just love the tech, then you're probably going and just buying the tech. I feel like this is more kind of a kind of an advisor kind of checkbox that can mark maybe a few at the same time.
Yeah, what we're actually seeing is you're seeing a lot of RIAs come into the space. You're seeing a lot of institutional investors.
They can check the income box, they can check the crypto box.
Yes, because what they do is they have income portfolios, but those income portfolios haven't been delivering a high amount of income, which these do provide a high amount of income. So it actually increases their income. And if you have it into a blended portfolio, you're not taking outsized risk, right? Because you're going to take 2, 3, 4, 5% positions in these, yet increase your income levels. And so that's where we're seeing a lot of attribution in this, especially because they know they're going to own this over the long term, right? Like, they're not going to own it for, 6 months to a year. They want this space to grow. And so another thing we're actually starting to see some attribution in is people that own crypto, but have owned crypto and staked. So staking rates have come down on Solana. Staking rates have come down on Ethereum, and those typically have lockups. So what's nice is that we're an alternative to having crypto and then staking them. So that's the nice aspect as well. So we're actually seeing two attributions. We're seeing investors who are crypto native that see this as an alternative, where they can have 80% to the spot underlying and 20% to us to generate income that they were going to stake anyways. Or you're going to see income-focused investors, because if you look at BITY, for example, Bitcoin, right? You
2%
don't have
monthly
a
option income ETF. I'm on it.
Yep, you don't have sovereign risk. You don't have corporate risk, right? There's no issuer. So the nice aspect is you don't actually have to worry about, some of the things with companies where if they miss earnings or if a CEO gets ousted. So that's the nice aspect here.
You don't have the idiosyncratic risk.
Yeah,
I like that.
You're removing a lot of. Yeah.
For the Solana then, right? Because you guys just did this for Solana. I mean, if you're, let's say you are an advisor, right? How do I figure out if, okay, should I do this income approach through Solana or Bitcoin? Is it just that if I want a little bit more and I want to accept a little bit more volatility, I go for like the Solana? Is it like a beta thing, or how do you think about it?
Yeah, it's a diversification risk if you're doing it blended with like a BITY or you're doing it with ETTY. But holistically, the way you're thinking about it is Bitcoin is actually digital capital, while you look at Ethereum and you look at Solana as digital infrastructure. We're building out the rails for financial institutions globally now, right? So I'll give you an example. Western Union is almost 175 years old. They've got 200, they're operating in over 200 countries. They are building, so they don't get Kodak'd, they are building their next generation of remittances on the Solana network, right? So why are they doing that? Well, if I was going to send money overseas, it'll take days to settle. There's a lot of high fees and costs. Well, how do you remove that? Well, one way you remove that is you build it on a digital infrastructure network like Solana, and you have they're having their own token, their own stable coin using Solana. And what you can do is you can get instant settlement, you can reduce costs. And so it's really reducing a lot of slippage and friction within the financial infrastructure that's in place today. So they're hoping to have
that. That's a good Solana pitch. It's a good Solana pitch. I just think if I'm an advisor, I probably don't even care about all that. I'm probably just going, what's my income and what's my range of outcomes, you know? So in terms of the range of outcomes, I think a few things that kind of have been pointed out, but maybe are worth pointing out, is that some of the income stuff has come under some criticism, and that the way the yield is described, people are expecting that to be a different form of return. Do you want to talk about that for a second, Kevin? Just because people look at a yield and then they'll look at an SEC yield and they'll go, okay, all right, how do we explain the difference, basically? What's the key thing people need to know to realize, hey, this is not like a capital return?
So the way you classify returns is return of capital, and that's just an accounting mechanism. So what you want to do is you want to look at a strategy and see if it's destructive, right? Are they actually returning your capital to you, or are they growing their NAV? We generate our returns, our yield, through options premium, right? We're monetizing volatility. And so with that being said,
mostly through the selling of options and spreads, right?
Yes, exactly. We're selling options against the underlying. We're doing it every week. We're doing it out of the money. So we want to give as much upside as humanly possible to track the spot. But at the same time, it's going to get capped a little bit. But we're trying to target 5 to 10% out of the money every single week. Collect those options premium, and then every month pay out that to shareholders at the end of the month. So return of capital is a classification under the accounting rules. And so we're not actually returning capital, your own capital to you. It's just the way it's accounted for under GAAP principles for the actual funds.
Got it. And that's where, again, I just see this really as an advisor-driven product. I see it as a version of what people are doing in all kinds of different custom option strategies and SMAs and overlays. It is the whole idea of just complementing or replacing to some extent the function of bonds. Like it's structured to provide that income. That's the kind of continuous rate, the predictability of it, and you're just saying, hey, we've got a new asset class that can provide this for you, and that's crypto. It's high beta stocks too, right? All the yield max stuff, et cetera. So it's this is the hot ETF spot.
Yeah, and just in that vein, I mean, you're actually seeing it on the corporate side because MicroStrategy has, which you previously discussed, is coming out with fixed income products to the marketplace that have higher yields as well, backed by their Bitcoin, right? And the way we like to think about it is that we're low volatility, low beta versions to the spot. And so, we're not levered. It's one-to-one. That's why advisors, this is a great tool for advisors to look at, to implement for higher amounts of income in the portfolios, because we are unlevered. Right. And exactly what we're doing. We're systematic, and we have a methodology behind on how we write the options. And it's important because there's not a lot of great places to get income. And so if you know
Yeah.
what you're getting into and the exposure you want, this fits in a great bucket on a fixed income alternative, especially against
I
things
think
that
the
are out there.
competition that is arguing is all, the alternatives, the kind of whole private market. It says, okay, we've got a solution too for bonds. It's diversification through these private assets. Kevin, when we're thinking about options, real quick though, is for these funds, okay? So what's the pain point then? Because to the point of where we began, which is Bitcoin down right now in price, up in volatility. The up in volatility part means you can harvest more because the premium you're getting from the options you're selling is higher. So this is not a bad situation. What would be the bad situation? It is a hypothetical in which price goes down and somehow like vol goes down? Because I don't really see that as a thing that happens. It happens in the stock market sometimes, right? You'll have instances where VIX and S&P are not inversely correlated.
Yeah, I think one of the things to take away is that in any option writing strategy, you don't want that quick whipsaws back and forth, back and forth, back and forth. And so I think that is really the pain point, because if you're selling options and you sell them when they're down and then it goes back up, and then you sell them when they're back up and it goes back down, that's always. Yes, exactly. I think that's the biggest pain point. And we're not really seeing that because the asset class has matured. So it's not like you're in a small cap stock that can whipsaw around pretty frequently on a daily basis, up, down, up, down, up, down, especially because institutional flows. And I would also like to point out that volatility can go up when the underlying asset class goes up, and we've actually seen that in Bitcoin. So we saw that at the end of September. So these are asset classes.
People watch it. It actually happens more often in stocks now. Stocks up, vol up, because everybody's buying all the options and the calls.
Exactly. So the biggest concern that advisors have is, well, what if vol goes down, right? And how are we going to generate? Well, the one way to think about this is, because these are emerging technology networks that are still in the life cycle of what they do, still newer, right? I mean, Bitcoin was created, back in 2009. We've seen volatility stay between 40 and 80, and it kind of trades, and vol goes up and down within that range. It has.
You generally know what to expect.
Yeah, exactly, and that's analogous to a Tesla, right? So for Bitcoin in general, I would just say that it's comparable to the Mag 7 names. Like one of the things that advisors have actually taken on to is that if you want to turn your Mag 7 into the beautiful 8, you can add Bitcoin exposure via BITY and BAGY, because it has a similar historical volatility profile.
Nice. And you've done a good job kind of weaving some of the crypto bull case in there. The other thing too that I was talking about at the top of the show is that I think Bitcoin offshored some of its volatility components to MicroStrategy, since it's a levered version of it. And even me as kind of still the lingering Bitcoin cynic with my bearish divergence that I talked about ad infinitum, by nature, even though that's a bearish thing, it's one that first involves a compression of volatility. So even it all adds up, right? Even from the bearish side, it kind of fits in. Kevin, you the man, great conversation as always. Thank you very much for bringing us the details on the funds and jumping on. You the man.
Thanks so much, Oliver.
You got it. Appreciate it, man.